So this is one area which has recently undergone some revision, that is issuance of shares at a premium. So I have first taken up this section 56 to 7B, and now it has been made very comprehensive. So if you see now the amended provisions, it captures many other methods also. But let's understand, to whom does it apply? What are the exemptions? And what are the methods? So we'll first cover 56 to 7B. So that gets triggered when there's an issue of shares at a premium. And the company should not be a company in which public are substantially interested. So these are the two things. Secondly, if the issue is to certain categories of people, like if it is to a venture capital fund or a venture capital company, or it is to a notified person, which is, there's a notification which has recently come, and that notification was issued in May 23 itself. So as per that notification, there are certain countries and the entities of those countries who also will not be, to whom when you issue shares at a premium, 56 to 7B will not get triggered. So these are the basic things which you have to remember. Issue of shares at a premium. Secondly, company that is issuing the shares should not be a company in which public are substantially interested. And again, one has to look at the definition of company in which public are substantially interested under section 218 of the Income Tax Act. And the person who is subscribing to the shares should not be a venture capital company, or it should not be a notified person. If it is these things, then it is exempt, or everyone else is now covered under the trigger of 56 to 7B. So the premium has to be benchmarked, and the benchmarking has to be against the methods which are prescribed. Yes. So here are the notified entities. In case if I think the study circle will even circulate the presentation, so you will be able to read it. So these are the different categories of persons who are notified. So basically, if it is a government entity or it is a pension fund, so most important, and you would have seen that Canadian pension fund is a big investor in India, right? So if there is some shares which are issued by a company in which public are not substantially interested to CPPIB, that is Canadian Pension Fund, in that case, that will not trigger the provisions of section 56 to 7B, because the country of Canada is also notified and it is a pension fund of Canada, and so it is an exempt entity for subscribing. But that does not preclude the company, that is CPPIB, from application of 56 to 10. So 56 to 7B doesn't get triggered because it's a notified entity now, but 56 to 10 does become applicable to the recipient. So now what are the methods? Okay, so we'll just briefly discuss the methods. So one, what we know is the asset-based value. Under 56 to 7B, when you do a net worth calculation, you are not really allowed to do a revaluation of the immovable properties and all. It has to be at just book value. If you read Rule 11UA2A, I think, yeah. So in that, this method is given, which is just the assets minus liabilities, and there is no revaluation of immovable property, underlying investment, nothing, everything has to be taken at cost. So that is one method. So this is a very interesting thing, that when the government wants to tax, they will give you an approach which gives you a low value. But when they want to, in case if you are taking shares, then they'll say, okay, the higher. So it's a very interesting thing over here. They have said that you take book value of assets and liabilities. So that is one. The second approach was always DCF approach. Now there's a big amendment which has happened there. I'll come to a flow chart, kind of presentation, which will give you all the methods which are prescribed for the different categories of people. So the other method is DCF, which was always there. And the third method is, underlying values of intangibles and tangible assets to the satisfaction of the assessing officer, which means that it is a method which will have to be triggered at the time when you are actually presenting or you are submitting to the assessing officer. But I would say that means I have personally I had to do one valuation for 56 to 7B considering underlying values of tangible and intangible assets. I gave a report based on that because the company otherwise had really nothing in it, but the company had such valuable properties that if the underlying values of assets and intangibles were not taken, then this premium could not have been justified, and DCF was not possible. So there are certain instances where you have to adopt the approach. We will also discuss about the sanctity of the methods adopted. For that, there are many case laws. So that is also something that we will discuss at a later stage. Yeah, I will first come to this. Okay. So now if you see this chart, what are the new methods? One is the venture capital undertaking transaction value. Then there is the notified entity transaction value and other methods. Now, if you see the drop down of resident person acquiring shares. So when shares are issued to a resident, the method that you have is the book value of assets and liabilities. That's one. Second is a discounted cash flow approach, which was always there. Third is benchmarking against the venture capital capital funds investment, and fourth is the benchmarking against the price at which a notified entity has invested. So these are the four for resident. For non-resident, in addition to these four, there are other methods which are prescribed, and these are widely accepted methods, such as the comparable companies multiple approach. You have the transaction multiple also, which flows into the CCM approach. You have the probability weighted expected return method. Then you have a milestone based method, mainly for you can use for startups and early stage. Option pricing model. And replacement cost. So basically all the valuation approaches which are internationally accepted are all flowing into this. So why this? Why is it only for non-residents? Because I think there was a lot of noise made about this, that when you have to do a valuation for the purpose of issuance of shares to a non-resident, you have to also do as per Fema. Valuation has to be done under Fema regulations also. Under Fema, one has to follow the internationally accepted valuation methods. So when you are issuing to a non-resident, you cannot take less than the amount which comes under the internationally accepted methods. It is possible in many cases that DCF is not relevant. It's not a relevant method. And so you would go with CTM, CCM, so many other methods which are there. So the price that you will arrive at for issue of shares to a non-resident could be higher than the value that you arrive under the prescribed methods under 56 to 7B, which is the highest, probably could be DCF. I'm not saying it has to be. DCF may not be always the highest method, but sometimes highest could be DCF. And because in case of Fema, you have to issue at price not lower than the internationally accepted valuation method, and that value could be much higher than the prescribed methods under the 11 UA Income Tax Act. So there was a mismatch. So there were instances which I have come across where people said, okay, we will have to pay tax on this difference. There is either they pay, means we will have to bear this tax because it is an unjustified premium, but we can't really help it. We'll take this kind of money. So that is why for non-resident, the other methods are now accepted. But I would say that why is it only for non-resident? When there is a value of a particular company in a particular business which can be only done under CCM and not DCF, then why is it that for resident the other methods are not applicable and only for non-resident those methods are applicable? Very frankly, the rule should be further amended so as to make these methods applicable to everyone across the board, because this is not fair. I'm coming to the earlier slide. This is now 11 new. This is an amendment which I have highlighted. valuation date. So valuation date, as per, because it's very, very important. This is where people always get stuck. So valuation date is a date on which the property is received or the consideration is received. Okay, so that is a valuation date. And now there's an amendment which has been brought about, which says that in case if deemed valuation date is Rule 11 UA3, the date of merchant banker's valuation report will be deemed to be the valuation date if the date is not more than 90 days prior to the date of issue of shares. Which means that if a merchant banker has given his report, like not a chartered accountant's report, but a merchant banker, if he has given his report on a day which is, say, if the transaction is happening, say, in January and the report is given, say, in December, then that report will still remain valid and that becomes the valuation date, because we come to the meaning of balance sheet. The balance sheet has to be drawn up on the valuation date. Now that becomes very, very difficult, because how can you do the, draw up the balance sheet on the transaction date when you are still doing the transaction? It's a chicken and the egg situation. Mostly people cannot do it on the date of the transaction, at least when the transaction is happening. Mostly people draw up the balance sheet, if at all somebody is really very compliant, post the date of the transaction, they draw up the balance sheet on the transaction date. And this balance sheet has to be again drawn up by and audited by the auditor of the company, who is appointed under the section 224 of the Companies Act. So a statutory auditor has to be the person who should audit this balance sheet and give you. Or if there is no balance sheet available on that date, then you can take the last audited balance sheet which is approved by the shareholders in the AGM. So these are some key things which I thought I'll just bring out here. So this is 11 UA2AA, which is the assets minus liabilities, just the book value. We'll not dwell on this more. Now, I thought that because this is a session on valuation also, so let me cover, valuation overview of the method which is to be adopted. So let's look at what is there under discounted cash flow. So under discounted cash flow, it is really what we are trying to find is value of every rupee invested in the business. So when you do free cash flow to firm, you are trying to find value of every rupee invested in the business. What is relevant is the cash flow and not just the profit. We make a mistake often by just saying, okay, this is a profit, this much multiple, but profit is not really the cash flow. A company earning good profit may also still be very cash strapped, and really there may not be good value in that company, because that company might have huge capex. Like in case of telecom industry, if you see, they have to continuously do so much capex and so much investment. There are these auctions and huge investments which are continuously required. That if you see the cash flow, I'm sure it would be very, very meager, at any point. So cash flow is what is very important. Second thing is also working capital. Often people forget about considering working capital when they do a valuation of a business or they look at the financial model. Working capital is very important, because that is where your money gets stuck. You think that so much is your profit, but that money is not going to come to you for at least 2 months, 3 months, depending on how efficiently you are managing the working capital. And so in discounted cash flow method, we consider the working capital outflow also, we consider the capex also, and we find out what is the value of every rupee invested in the company. Now, the other question is that when you do a discounted cash flow approach, should you be considering nominal cash flow or real cash flow? Nominal cash flow means cash flow in terms of, expressed in terms of after including inflation. In case of real cash flow, you are, you freeze the currency, you don't consider inflation, and you take the real cash flow. So I just thought I'd put this up because sometimes people come up with these questions, or they have some misconception that why should we take nominal cash flow because it includes inflation. But I have just one explanation here, that when we do a discounted cash flow approach, we have to also consider the risk-free rate of the currency, and risk-free rate builds into it the inflation, the country default spread, and everything. So when you are for discounting, building the inflation into the discounting rate, then if you take a real cash flow, then there will be a mismatch and you will undervalue the company. So cash flow should be always be nominal cash flow. That is after considering the normally accepted or expected inflation in cost and revenue. So there are different methods. One is free cash flow to firm. Third is free cash flow to equity. So what is a preferred method? Mostly people prefer free cash flow to firm. But there are certain businesses where debt is very much a part of the business model, where you have to raise debt and you get your cash flow only if the debt is raised, and then you substitute, means the debt is repaid, you keep on getting cash flows from, say for example, if there is a development of real estate, then you will have to use probably free cash flow to equity. So this is a pro forma of DCF model. So you have the start with the EBITDA and all these outflows on account of fixed assets. I have to just bring out one more thing. When we look at capex, that is outflow on account of fixed assets, and I've just written here 3 years, but we should normally take a 5-year cash flow from the client, and then we have to build perpetuity or continuing value. Now, when we look at this free cash flow, capex, that is purchase of fixed assets, outflow on account of fixed assets, you should also match it with the depreciation. Sometimes people say that, why, we have just incurred the capex, we don't need to incur now for next 20 years, there's no need. First of all, it is not correct assumption that for 20 years you will not incur any capex, or maybe you may not incur a big one, but you will have to provide. What is depreciation? That is really providing for the wear and tear in the machine. So at the end of your projected period, if in perpetuity you say that there is no capex in the last year and so I will not take capex, that will be a wrong, it's a faulty model of DCF. You must take at least capex equal to depreciation in the last year for building your perpetuity. Then we have the discounting, that is written here, mid-year discounting. Now that is a preferred way of discounting. You don't take end of year discounting because that means that cash flow is only accruing at the end of the period. But that is never the case. Cash flows accrue normally evenly during the year, and so mid-year discounting is a preferred way. However, if there is an instance which suggests that cash flows accrue, say, in the first 4 months only, and then it accrues after a certain period, like for example, a seed company, you will have a lot of cash flows which will happen at a particular time, and then it is kind of a slack season in terms of cash flows. So in different types of companies, if there's a peculiarity, you might have to change your period for the discounting. Okay. Then we reduce the debt and contingent liabilities, and then we add the surplus assets. And in surplus assets, normally if there are investments which are free investments out of surplus funds, there are free deposits, fixed deposits, cash balances, then that is considered in surplus assets. Then you reduce the fair value of preference shares. Okay, and you come to the value. Now, just one interesting thing here which I want to bring out. If you look at 11UA, it says that you reduce preference liability. Means when you are considering the liabilities, you don't exclude preference liability. Okay, which means that it is considered at the book value of the shares. Whereas in a fair valuation, one always has to do a fair valuation of preference liability, unless when you're building WACC, you have considered for preference shares the cost as the coupon of the preference shares. If that is considered as cost and not the market yield of preference shares, then okay, you can take preference shares at face value over here also, because you have already adjusted the weighted average cost of capital by the with only the coupon rate of preference shares. Then you have the illiquidity discount in case of companies which are not listed companies. And since we are looking at Rule 11 UA2, it is typically used only for companies in which public are not substantially interested. And so there will be always illiquidity discount. There would be instances where company would not, company could be a company in which public are substantially interested as per section 280, but it would still be not a listed company. But anyway, that doesn't fall under 56 to 7B, so we are not bothered about that. When we, I think I did not talk about companies in which public are substantially interested. I'll cover that a little later. Otherwise, it will break this. Yeah.
How to quantify that illiquidity discount?
So see, it is a convention which has been fixed, illiquidity discount. So normally illiquidity discount is taken at 15 to 20%. But there can be instances where you know that it is the company is soon getting listed. You may decide to do away when you can actually see that the listing is happening is just around the corner, or you know that the DRHP is filed, the roadshows are happening, then you might have to bring down this 15% discount. So depending on the situation, you might have to, in certain cases, bring it down, but otherwise 15 to 20% is illiquidity discount, which is normally taken because this is not a liquid stock and you cannot readily just sell it at the fair value. It takes a lot of time to sell any liquid stock. No, contingent liabilities cannot be considered. I'll just go back to that. But that is, so, but contingent liabilities cannot, because you have to go with the books, whatever is there in the books, what is provided in your balance sheet. Contingent liability is not provided in the books, in your balance sheet. It's not a provision. Contingent provision cannot be considered. Okay. And since it is contingent liability, even if it is crystallized, because it is not yet brought into the books, you cannot consider it. Simple.
And what about the DTA we have created for the employee tax benefits or something like that? If we have made a DTA, DTA is coming in the books, is that considered in the total assets?
So we don't consider that in assets.
Okay. So while like that is also
So if you
are getting benefit out of it, like in the future.
No, so I will just tell you what we, so what can be considered is the amount of income tax paid less amount of income tax refund claimed. Just a minute. If we look at the liability part, okay. So provision of taxation, what is to be excluded is provision for tax excluding advance tax and refund due. So if you have provided, so supposing you provided more tax, so when there is a DTL, supposing let's forget about DTA. If there is a DTL, it's a provision which is made for an amount which is contingent on future. Okay, it is not a tax on your present profit. So that provision, if you were to consider, then you will reduce your net worth, and so DTL cannot be considered. And so on the same lines, and we don't even consider DTL.
Madam, all this valuation we are talking about, usually say 56 to 80, right? And our certificate has got no value. Only the merchant bankers are something like this.
Not everything. That I have a slide on this. Okay, what can be done by us and what can be done by merchant banker. But I agree, most of the things are taken away from us.
What is our role in this? Why are you doing all this?
No, you must know it, right?
Yeah, it's okay. But practically, you are going to implement your certificate for valuation.
So most of the time what happens is that, if you see the merchant bankers, for small transactions, you cannot even rope in a large merchant banker who has good experience. The smaller merchant bankers may not be able to do justice to this and they will need a lot of guidance. So you as an advisor will have to actually advise them on, how you can go about the valuation. You have to handle, otherwise, these merchant bankers for these small transactions, what is the role of a CA? It is a positive role.
Ultimately, but then ultimately he will go to certify, right?
He will certify.
Accept a lot of what we are going to suggest for the natural valuation.
So that is the same thing for fairness also. Even today, when there is any merger, demerger of a listed company.
Now the things have been taken away from us and then the whole government is going to be merchant banker, right?
That is
There are officials in merchant banker, they are other owners, they are like, how they will not be able to.
so merchant bankers actually don't focus so much on this. They don't focus so much on really valuation. Very frankly, there are very few who do. Huh.
I think DCF is merchant banker, balancing asset liability.
Asset liability we can give. DCF is merchant banker, and all the new methods are also merchant banker. So that I know, I have brought it out, but I'm saying that most of the methods are now with merchant banker. All the new methods which have come in are also for merchant banker, not for us. They are not for us.
Only one is left, asset liability.
Only asset liability is still left with us. That's it.
Now, what if the NAV value comes below the face value?
Then face value, then you are not even triggering 56 to 7B.
Because
You cannot issue share at a discount, right? So you will issue at just face value.
So what section we should apply?
You will find your value based on NAV, which is less than face value, and then you are just doing an issue at face value. Your report will simply say that as per 11 UA, this is the value, and then the company will have to take a noting of that, and they will issue share that. Why are the slides leaving? Yeah. Okay.
there is a revaluation.
I can't hear this. Yeah, tell.
Because of India, there is a revaluation of land. So in the book value, you will deduct it?
No,
No.
can't reduce it.
It can be anything, na? Land, business, partner, anything, because of the India.
Yeah,
You may not do.
no,
Because our deputy ratio, other issue we did.
yeah.
And for
Well, this is a very wrong approach actually. This 11 UA method is a straight jacket kind of asset minus liability, which is not, according to me, the right way to compute fair value anyways. Very few cases where you can compute fair value in this method.
Okay, thank you. Madam, buyback of shares can be applied in input.
Sorry?
Buyback of shares can be applied in input shares.
See, there are judgments which have clearly held. There's one judgment which says that on buyback, there is no property received by the company that is buying back the shares. So 56 to 10 is not triggered in the hands of the company that is buying back the share. And for the shareholders, 50CA cannot be triggered because buyback is exempt under section 10. So no income can accrue to a shareholder under buyback. So 50. Sorry?
20%
Yeah, 25%. Na? Buyback is 25% of capital and reserves together. Free reserves.
And in case of any family, which shares are held by the family members. So that membership is applicable because they are transferring in with you.
They're transfer. Okay, so is it buyback by the company or is it a transfer? So no, because the relatives are there. Na? So basically, any transaction between relatives will not trigger section 56 to 10. But 50 HUF also you can take the shelter that it is between, means HUF is formed by the same family members who are anyway exempt, and so there cannot be any tax. You can take that position.
You are saying current asset, we are considering here, current assets minus current liabilities, but still we are supposed to exclude DTA and DTA.
So there are certain things which have to, so we don't include DTL. So because we don't include DTL, we also don't include DTA. So DTL we cannot include because otherwise you are providing, if you reduce the value, if you want to conveniently reduce the value, you will provide for certain deferred tax liability and then you will say that, okay. And if you see the provision, it says what is allowed to be reduced is only provision to the extent of, tax payable on the profits of the company. So deferred tax liability is on a future kind of profit. So that you cannot. Okay. So DCF method cost. Okay. So now let's look at this question of what is the discounting rate for free cash flow to firm and free cash flow to equity. So when we do free cash flow to firm, we don't reduce interest for computing the cash flows, and so the discounting happens at weighted average cost of capital, which is the cost of equity, cost of debt, and in case of free cash flow to equity, the inflow of debt, outflow of debt, interest payment, everything is reduced, and you are left with only cash flow left for equity shareholders. And so you take the cost of equity as the discounting factor. Yeah, just one more thing. I've just brought this out here that the weight which can be used for WACC, that is weighted average cost of capital, could be the industry debt equity, or it can be company specific debt equity, or it can be the target debt equity. But one has to choose which is the right one depending on what is the situation that you are looking at. So I'll just give you one example that if I'm doing a valuation, this is not okay. So I'm supposing I'm doing a valuation for say sale of my business. It is not really. I'm not looking at 56 to 70 at this point. But if I'm doing a valuation for sale of business, and I am zero debt company, but I know the acquirer who comes in will definitely, use some leverage and reduce his cost of funds. And I know that in the industry, people are using, say, 40, 50, 50 debt equity or 70, 30 or whatever. So I would I would value the business considering what is the industry debt equity, because I am putting up this business for sale. So why should I give that investor the advantage of paying a low value for my business? But of course, as we go along and when we do all these computations, you'll realize that really speaking, WACC and cost of equity will more or less align, because when you compute the weighted average cost of capital considering certain leverage, your cost of equity goes up substantially, and that is balanced by the cost of debt. So on an average, it comes within a particular band. And then when you just take the cost of equity of a company which is not levered, it would have a much lower cost of equity. So it could be in a similar band. So what is most important is really just the risk of the sector, which is in beta. So this is that formula, which is a CAPM formula, which is for computing the cost of equity. Short, very short, I'll just tell you, this is risk-free rate plus beta into equity risk premium of the market. So whatever the total risk, equity risk premium of the market, that is what is considered. And you multiply that with the sector-specific specific risk. Okay, so then you will get, maybe if the sector risk is lower than market total risk, then you will get a lower equity risk premium for that particular stock. If it is higher, then you'll get a higher cost of equity based on this. I don't want to go too much into the leverage and all. If you want, you can just look at that slide. Then we have the terminal value. So this is very, very important, because at least 60 to 70% of the value, at least, will flow from the terminal value or the continuing value. So terminal value is very, very, very important. So what are the key assumptions which go into terminal value? One is the cost of capital. Second is the growth. And it may happen that in the last projected year, the company says that my growth will be 40%, but you cannot expect the company to grow at 40%, right? But would it be correct for you to just bring it down to say a 5% growth, which is a stable period growth? That also will not be very correct. So you might have to then use something that we call as the H model, where we do a linear decline in growth, and we compute the value and then bring it to stable growth of say 5% or whatever is appropriate for that particular case. There are certain businesses, say for example, if there's a power project. So in case of power project, you have the liquidation value after that 20 years of the life, or 25 years of life of the plant, where you have the scrap value, and then you will recover all your working capital. So then sometimes it is also a long period cash flow, maybe 20-25 years cash flow based on the purchase price, the power purchase agreement, and you take at the end of it the liquidation value, the scrap value of the plant. And the easiest is the stable growth approach. Again, under stable growth, there can be a situation where you may say that this business is not likely to continue for more than 15 years. It does happen. You sometimes come across a particular type of business which is right now running, it's generating profit, but this is a sunset industry. So in that case, there will be a limited period continuing value. You will not take perpetuity because it is not likely to continue. Okay. So this is. But then, okay, so why would you take over a negative company? That is the answer. Now, if you see there is some future in that, then you will give some value for that, right? आप नहीं दे रहे हैं. हाँ तो नेगेटिव है तो नेगेटिव नेटवर्थ है. नेटवर्थ आपका नेगेटिव है. Of course, yes. Book value means you can take nominal value, you will take it over at whatever, because it will be still higher than your 56/10 value. That is right. So there's a negative net worth. Correct? There's a negative net worth. But you will take it at a nominal value, say 1 rupee, 2 rupees or something like that, right? The shares of the company. You are talking about buying the shares of the company. You have to give. How can you make a contract without consideration? Transfer contract has to be with consideration. You cannot. Which one I'm talking about?
He's talking about Lakshmi Vilas Bank become or by.
Achha, you're talking about that kind of a thing where there's a merger or something like that, or take. No, so that. No, so that then. See, the thing is that again, there also one has to, of course, there would be a valuation which should be done based on the assets, based on the liabilities, and finally, there is, even after doing a full-fledged valuation of the bank, there is still a negative value. So you will give some token, something, something will have to be given. कौन किसका मेमोरेंडम नहीं अलाउ करेगा? क्यों नहीं? ऐसा कोई रिस्ट्रिक्शन अगर नहीं है तो there is no problem. Why should a memorandum not allow? Generally, what happens in a case like this, you'll say that again, say 1 lakh shares, 1 share. So practically nobody gets any shares. So at least for the sake of taking over, there is some consideration, because a contract without consideration is not a valid contract. So even an agreement, whatever scheme, everything, so
consideration is the liabilities are taken.
That is right.
So
That is right. That is right. That is, but then the liabilities are far in excess of the assets that you are. Sorry.
Is it possible as per memorandum of the
Yeah, why not? No, I have not come across any memorandum which say that company with negative net worth cannot be taken over. Generally, means unless there's something which is provided in the memorandum, there is nothing to buy. You cannot issue shares at a discount. That is one thing. Then you have to go to central government for approval. But buying over something at the fair value, or if there's a negative net worth, you are taking it over. Because in this case, the government directive is there that you have to, somebody good has to take it over. Otherwise, the bank will fail.
It is NCLT rule.
Banks don't go under NCLT. If it is a bank you are talking about, banks are governed by the Banking Regulation Act. So under section 44A of the Banking Regulation Act, so a bank, if it is a bank to bank, it is not governed by NCLT. It will not go to NCLT. Doesn't have to follow only that process. It's a complete code. Yeah, it just goes to RBI. It's a complete code, just 44. Okay, so this is just a simple formula that I have given for the perpetuity value. So you take the cash flow of the last perpetual year, that is year after the last year, and you consider the WACC and reduce it by growth. This is nothing but a modification of Gordon growth model, which is taken, and this is put in to calculate a perpetual value at a stable growth. And as I told you, in case of FCFE, what one has to start with is free cash flow to firm, and then you reduce interest cost and you take the debt outflow inflow also into account to compute the free cash flow to equity. Now we come to this new provision which has come, which is there is an exemption which is provided when a venture capital fund has invested in a venture capital undertaking, and if that value is considered for a subsequent transaction which happens within 90 days of the original transaction, then you don't have to go for a valuation. You can consider the value which is taken by venture capital fund for investing into this venture capital into this company. So I have just given here all the definitions of what is a venture capital fund, venture capital company, and undertaking. You can just read it up for your understanding. Most important word here is that the government has put a kind of a cap on how much funding will be exempt. So when originally a venture capital fund puts money into this company, and then later on this value is taken as a benchmark for the subsequent investment, then is there a means can you invest how much ever in the subsequent round? No, you cannot. So because government is very conscious of this, that what somebody can do is that ask venture capital company or fund to invest at a extremely high price, with a very high premium, and then subsequently do bring another investor for a much larger amount. So that initial investment of that venture capital fund can be just a token amount, and then later on there can be a large investment that can come at that price. So government is aware that people will play around with this, so they have put a very nice cap here, that the total investment from the subsequent investor cannot exceed the investment by the venture capital fund. So this is a very important thing. People may miss this, so it's important to remember that you can only get the cap up to the amount invested by the original venture capital fund. And
This for investor or in total?
in totality, na? Because if you are supposing initially venture capital fund has invested, and then you are bringing in some more investors, you are bringing more number of so total number. It cannot be, otherwise you will bring, you say, okay, this one, no. No. And that will be done by the venture capital, but here is a different thing. Here there's a cap on the amount that can be benchmarked against the venture capital fund's investment. That is the cap. There's a cap. So if venture capital fund has brought in say 1,000 rupees, then the investment from the other investors to the extent of 1,000 rupees only, you can claim the benefit of this pricing and rely on the price of venture capital fund. But beyond that, you will not get this exemption. But then it has to be substantiated, which you will be able to because you have brought in premium. So you brought in premium. But convertible debenture will not fall under 56 to 7B. Convertible debentures, I agree with you that under Companies Act, convertible debentures also fall under preferential issue pricing, But for Income Tax Act, 56 to 7B covers issue of shares at a premium. Convertible debentures are not covered under this. Preference also included. There is a judgment also on that. So this is a simple chart. I think it's a very simple thing that you can benchmark against this, venture capital funds investment. You can read it. Yeah. Now we look at the other approaches which are there. One is market approach and cost approach. Venture capital funds investment and also notified entities investment. So both the places you have the same provisions of the cap of total amount, and you can benchmark against the price, provided the next investment comes within 90 days. Okay, that answers it, that the next investment should come within 90 days, otherwise it will not enjoy that. Then you'll go with the asset-based value. You'll get your premium anyway. Okay, so under market approach, it is the comparable companies multiple. Normally, market approach is defined as a value which is based on multiples of comparable companies or comparable transaction. So that is the market approach. And I've just listed what are the different approaches. That is EV, EBITDA, price to earning method, price to book method, turnover multiple. Comparable transaction method also would be covered under this.
Future cash flow method can be applied.
That is anyway there, na? DCF we've already covered earlier.
Cash flow.
Future, that is discounted free cash flow, it's always future. That is covered as one of the methods, it's already there. These are the new methods. This has been what people are saying, it is now relief for non-resident investors. So these are the methods which have been notified for the non-resident investors only, not for resident. For resident, DCF is anyway there. For non-resident also, DCF is anyway there. But in addition to DCF, for non-resident, CCM is also a prescribed method, and cost approach has also come in, and there are many other methods I just talk about. Another one which is a very interesting method, which is probability weighted expected return method, which you can, maybe it can be a yield approach, it can be, in fact, I had used a probability weighted approach in DCF, where the management wanted to really have a price band, or really the range of values. So we had used risk probability weighted average return, and we had adopted probabilities for the different levels of cash flows and come to a range. Now when you look at this, it could be based on the yield approach also, but it will be based on certain probabilities which are likely to arise. Then we have option pricing method. Now, option pricing method as such standalone can never be used for valuation of equity shares. Option pricing, it's valuation of options. But if you are, because you will have a base fair value or base value, fair value, and then you will build the option value, and then you will come to a future value. So option pricing method, I can only see relevant in 56 to 7B if you are valuing preference shares which have got a fixed conversion. Because if you have a fixed conversion, then you know that you will receive so many equity shares at a future date. So you will do an option pricing for that future date considering different volatility. So this is it can be used but has limited usage. So what are the different methods under option pricing? One is Black-Scholes method. The other is binomial method. So Black-Scholes is a very straightjacket, very fixed formula, where you have the volatility, you have the strike price, and you have the volatility, and you have the period of expiration, and you will compute the option value. And this is typically used only in case of European options, where option can be exercised only at the end of the period. The other method is binomial, which is a much more advanced method where you compute value of the option at different points in time, and you will take a present value of that, so that you can get this is a method where if the option can be exercised anytime during the life of the that option, then you can use binomial method very well. Of course, you can always use it for a European option also, because it's a much superior method of valuation. Then you have milestone analysis method. I can only think about milestone analysis method for say early stage business or a startup, you know. So for that, you can use normally a milestone, analysis method. That's it. And in milestone, it is a very, it's a thumb rule kind of valuation. Okay, that if this is a stage, if the ideation stage is reached, then this much amount will be provided to the company, and that becomes, the fair value. So actually, because at that stage it is very difficult to make projections, it doesn't have anything on the table. So now they have brought in even milestone method as one of the methods, but in India, this method is rarely used. It is only in US that these methods are used. But now anyway, after SVB, the startup funding has completely dried, So now I'm sure nobody must be doing this milestone analysis. Now I understand people don't even fund any venture unless they see profit. So that entire concept of funding losses, which was in vogue, has now actually it started, kind of phasing out. Then we have the replacement cost method. Again, this is only for non-resident investors. So replacement cost method, where you can take the replacement cost of the assets and liabilities, obviously no replacement cost, but replacement cost of assets, which could be very different from the book value. And it could be a good way in certain cases of valuation. Notified entity, again, I talked about that if it's on the same lines as venture capital fund investment. Now we come to preference shares. Again, if you see preference, so now there is a specific rule for preference shares also. Same methods have been prescribed for preference shares also. Other methods only for non-residents. It's a very strange thing. Because it may happen that when you are doing a fair value of preference shares for the recipient, okay, because 56(2)(10) requires that or any share that you are receiving, any share or security you are receiving should be benchmarked against fair value. So if you are receiving preference shares, you should be paying not less than the fair value of preference shares. Now, at that point, you will do valuation after considering the option attached to it. If there's a fixed conversion, if it is a variable conversion at fair value, obviously then there is no option value, because anyway the conversion would happen at fair value in future. So if there is a fixed option, then for 56(2)(10), you will do a valuation which will be a fair value, which will include the option price. But for 56(2)(7)(b), that method is not included for a resident. It's a very, it's kind of a mismatch. And when you do valuation of option of preferences, anyway, you consider the in a way discounted model only, because you take the coupon, you take the yield, and then you do a discounting, and then you'll have to bring in this option somewhere in that only to fit it into a discounted cash flow method. But it's a very strange thing. Then you have the safe harbor rule which is brought in, which was not there earlier. So if there is a 10% difference between the issue price and the fair market value which is computed, then there is, there won't be any charge of tax on that. These are some of the case laws which I thought I will list down. Okay, so I have half an hour. So what I want to just emphasize, maybe you can read it up. The gist of these cases is, one is that when a method of valuation is selected, the AO doesn't have the right to really change the method. If I have selected DCF approach of valuation, the AO doesn't have the right, AO or even the appellate authorities really don't have a right to change the method. There's only one judgment of Delhi tribunal where it is held that the AO can choose a different method, because in that case, when the AO and the CIT appeal asked for the detailed projections, with full assumptions, they were not provided by the company. And so they look like projections just made in air with a target price in mind. And so the tribunal said that AO in such a case has a right to change the method and can get a valuation done based on just the asset based value. Okay, so one is the method. Second is most important is the when the assessment happens. Assessment say comes up after when the scrutiny and everything's happening. It might happen 3 years, 4 years after your original infusion. If there's a reopening, it might be even later. Now, when the infusion has happened, you have certain estimate about the company's path, how it will grow, and everything. Often it happens that projections are also put before the board for and the assumptions are also explained, and the board says, okay, fine, we believe that these projections will be achieved. Yeah. So in case of a lot of multinational companies, they have their projections which are approved at the global level, and those projections have like they absolutely nothing can be changed in that projection by anybody in the world. So in this case, in case of Vodafone and Pesa, the CIT appeal, first the AO said that projections are not achieved only. So I will substitute the actual numbers instead of projections. And the CIT appeal said, no, I will not do that. I will keep it as it is, but the company has achieved only 40% of what they had projected. So I'll take 40% of the DCF value as a value. How can you do that? There is no such apportionment possible. Your revenue comes down by 60% doesn't mean that your other expenses, your capex, your working capital will also come down by that. So there is no sanctity about this kind of an ad hoc method. And so the IDAT said that projections can never be estimated with 100% accuracy. No human can project in that with that kind of accuracy. And so you cannot, CIT appeal is also not right in what he did, and the AO is also not right. Whatever were the projections which were made at the time when the issue happened, if they are fully fully substantiated, then those projections should be accepted. So this is a very important judgment. So you can read up then all these case laws. Yeah, so in this case, it is that AO can reject valuation, but he's not allowed to change the method of valuation. So he can reject the valuation, and then he'll say but once the method is selected, then he still has to stick to that method, and he will have to then appoint somebody to get a fresh valuation done, but the method cannot be changed by the AO. This is that Delhi tribunal, which is where the method is also changed. This is a very interesting case, so I've just written this very separately. So this is under the erstwhile 5627A. So there was an amalgamation which happened, and upon amalgamation, the merging companies were issued the shareholders of the merging company were issued very, very small number of shares. That's because they were the same set of shareholders. So there was no need really to issue shares at a fair value because it is the same set of shareholders. However, these merging companies had investments in their books. And the value of shares, once you find the value of shares, based on the number of shares issued, the consideration which was paid by the amalgamated company to the amalgamating company shareholders was much lower than the value of the investments coming in. So it was held that there is a trigger of 5627A in the hands of the amalgamated company. That was in 5627A. Old section. Now under 56 to 10, there is an exemption which is given for mergers, everything, so there was exemption for the receipt of shares on merger, but not receipt of that undertaking. The undertaking received by the merged company from the merging companies was not specifically there, and that is why there was this kind of an observation. But for all time to come, I think we should keep this in mind because sometimes there's a trigger under some other thing, and this case might go against. Okay, so second level subsidiary. So, yeah, I said that 218 I will discuss a bit later. So, 218, that is a company in which public are substantially interested, is a company which is itself a listed company, or it is a wholly owned subsidiary of a listed company for the whole of the year, or it is a step down subsidiary which is held by a wholly owned subsidiary for the whole of the year. And the wholly owned subsidiary also should be held by that listed company for the whole of the year. So, please remember, whole of the year is very important. It is not only at the point in time when the issue happens, because a lot of people make this mistake. So, and this judgment is just that second level subsidiary will also be a company in which public are substantially interested, and it will be eligible for exemption from 56 to 7B. That's clearly flowing from 218. This is I think there was a question that whether preference shares also will fall under 56 to 7B, and I said yes. And this is the judgment which says that yes, what is covered under 56 to 7B is issue of shares at a premium. So shares can be even preference shares. Sorry, this sorry. This is that case, Gini Global, and this is a very important. This is a very important judgment, which is where there was a conversion of CCDs into shares. Okay, so when the conversion of CCDs happened, then it was contended by the SSC that there is no receipt of money, and so it will not be chargeable to tax under 56 to 7B, although the conversion happened at a premium. Okay, so here it is, this judgment says that as per the section, it simply says consideration. It doesn't say money. So consideration can be money, it can be other form of consideration also. So if the liability is getting extinguished and against that you're getting share, that is a consideration. And so if you are getting shares if you are issuing shares at a premium upon conversion, it will still trigger 56 to 7B. This is a very good judgment. This is under for right issue. This is means I really like this judgment a lot. It's a very recent one. I think it came in April 23 or May 23 or something like that. This judgment says that when additional shares are issued to the same set of shareholders, which means that there are right issue made to the same set of shareholders on a pro rata basis, then 56 to 7B cannot be triggered. Same thing like Sudhir Menon, which says that if you are issuing right shares to the shareholders, then there is no trigger of 56 to 10 because you can't make money out of yourself. You are the same people who are getting these rights. In this case, also same thing where this is examined from the angle of issue of shares at a premium. Very nice. I really like it. Raipur bench. So under this, if shares are issued to the same set of shareholders on right basis, if you have issued at a premium, who's benefiting? There's no one benefiting. Ultimately, this was a legislation which was brought in to curb certain mischief. Right now, when you are issuing to your own shareholders only at a premium, really, then there is no trigger of 56 to 7B. Of course, if you do this and then later on you build that premium and then you do an issue of shares at that NAV, at that inflated, of course then there is a mischief, but then there can be you can even go under a reopening. Correct, that can happen, no? Although the issue is examined, right? This issue is, see, in the year of assessment, supposing this issue gets examined, so you'll say it is already examined, application of mind, everything is there, this case cannot be reopened. But there is some additional fact which comes in subsequent to that year. If there are those issues, to others at a very high premium, I won't say there won't be one has to then see whether that is justified or not. One has to see. Non-resident also will still be covered unless it is notified. Those notified entities from those countries. Even non-resident shareholders are now covered under 56 to 7B.
For right issue, there is no need for valuation.
No, right issue, as per this judgment, you don't need to get into a valuation as per this, because you are issuing to the same set of shareholders. So you are not, there's no mischief in that. If you are to issue to non-resident under Fema, if you see Fema, it says that if rights are given at the same price at which you are giving to a resident shareholder, then there is no need for a valuation for Fema also. So if it is right issue, Fema also kind of exempts you.
But if right issue can be like stock option employees. Stock option can go on the decision making. But it is every year.
A stock option is a completely different thing where you actually, so there is a fair value which happens of the shares, and then you have to value the option attached to the thing, the shares, and then you will you have the exercise price. So the difference between the exercise price and the value of the shares you will have to take from the shareholders, sorry, from the employees. Yeah. So I'll tell you, the two things are there. When there are stock options which are given to employees, and employee is subject to perquisite tax at the time when the stock options are exercised. Again, over there, the valuation has to be done by a merchant banker, unfortunately. Yeah. Yeah. And for company gets a charge of the options in the profit and loss. To that extent, the company gets a deduction. And it's a provision because it's a loss to the company, because company is say giving shares at 10 rupees, whereas the worth of that shares is 100 rupees. A fair value, if you want to do fair value, it is 100, and company is issuing at say 10 rupees, giving it at 10 rupees. Then 90 is a notional loss, and that gets charged off to the company's profit and loss over the grant period. Sorry?
No future right entitlement.
Right entitlement. But there are no shares only, na. If it is just an option, that right issue will be only to the existing shareholders, the members. Now, an option holder is not a member, and till the time he exercises the option, he doesn't become a shareholder. So how can he get rights? Yeah.
What I'm asking is that the private limited companies now, if they want to sell their company, it can be done by through the sale of shares also, right? So in case if I'm going to sell the share to other who wants to take over the company, same principle of valuation also applied where also there's only units and so on selling their shares to other sides.
Yeah. This is still, I'm still on 56 to 70, 56 to 10, and 50 CA and 56 to 10 are aligned, because 50 CA brings you back to 11 UA 1 only. So the same, yeah, it gets it. This is okay. This is a very strange case, again Delhi Tribunal, which says that ultimately this provision was brought into the legislature to curb certain mischief. So if there is no mischief, you cannot trigger only this provision of 56 to 70. That's amazing, So this is a very recent judgment, but I'm quite surprised. So it says that if there is no mischief, you cannot trigger the provision. It's a very strange judgment, but anyway, so it's good for us. And this is okay. Yeah. Now I will just come to 56 to 10. Okay, this was 56 to 7. I will cover everything. We'll discuss little later, because then I'll not be able to finish my topic. We can discuss बाद okay. Yeah. So now we come to receipt of shares. So here, if the fair market value is more than the consideration for transfer, or then in that case, more than 50,000 rupees, then in that case, 56 to 10 gets triggered. And what is property? Property includes shares and securities. So here, valuation date is a date on which the shares are received. because here it is not consideration, it is shares, the property. When the property is received, that is the valuation date. Balance sheet should be drawn up on the valuation date. So if you have, especially in case of an Indian company, it is a audited balance sheet which is drawn up under the Companies Act. And in case of company outside India, then it has to be again audited by an auditor of the country where the company is registered. So in fact, there are some instances where you come across, in fact, many cases where you are told that there is no requirement only to do audit of this company. So what do we do? What kind of balance sheet do we take? So it's a very interesting thing. We have to see how every case is different. Quoted shares, one has to see the the market price on the date of the transaction. So this first one I'm talking about is quoted shares. When it is a transaction which happens on the floor of the market, it is a transaction value which is recorded on the market, which is the 11 UA value. If it is a transaction which is off market, then one has to take the lowest price quoted on any exchange on the transaction date, and or lowest price on the last date before the transaction date if on the date of transaction it is not traded. Now, interestingly, I think I have, yeah, sorry, in quoted shares, what I want to just bring out is it should be shares quoted with regularity on stock exchange. And it doesn't mean frequently traded. It should be shares traded with regularity. So it need not cross the threshold of 10%, but there should be some regularity. Then it can be considered as quoted equity shares. This is the method of valuation under 56(2)(10). Here you are supposed to revalue the immovable property, but not plant, means land, but not building. Sorry, land and building and but not plant. If there are leases, I don't know, I think I've covered it somewhere. So if there are leases, then you need not value the lease. Lease you can take, leasehold you can take at book value, because it's simply because when you look at the meaning of property which is given under 56, then the meaning of property is immovable property being land and building. So it does not expand beyond land and building. Right in land and building is not covered by 56 for the 56(2)(10). And there are, sometimes some questions raised when we look at 11 UAE. 11 UAE is for slump sale. Now, slump sale is, earlier there was no rule, and then there is now a rule which has been brought in, which is very much aligned with this, that you have to revalue the immovable property, you have to revalue if there's jewelry or archaeological, whatever, artistic or whatever stuff and all that. So, and shares and securities, you will have to value as per the rule. So this is what is there under 11 UAE also, but under 11 UAE, which is under 50B, there is no specific, restriction of immovable property being only land and building. So people do take a view that even lease whole property should be revalued and should be considered at fair value for 11 UAE. That is one difference between 56(2)(10) and 11(3). This is okay. Yeah, this is that thing that I have already covered it. And we have, at least, I personally have this view that when for 56(2)(10), the meaning of immovable property is land and building, then for 50CA, because it brings me back to 11 UA, which in turn is under 56, which defines, immovable property. I will, for the purpose of 50CA, also restrict the meaning of immovable property to land and building and not leasehold. Otherwise, there'll be a big mismatch. So that's what I'm saying, that for 56, so 56 for under 56, property means immovable property means only land and building, and right therein is not. Okay, right therein is not. So about values also, it is still okay. From transfer of property act, you are trying to say that it becomes, it would be considered as land and building. But ideally, I would say because sometimes you come across cases where there are these large means long-term leases. There are these huge retailers, and you try to get into all the lease valuations and all. It becomes an impossible task. And secondly, to assume that there is any benefit which will be there in the lease is also a very remote chance, because the landowners and all these big commercial place owners earn out of these big retailers. So there's no real additional value and it becomes a very long stretched kind of an exercise. So can't really get into that. And when specifically the section says immovable property being land and building, just land and building right there, we will not include.
मैडम लीगल प्रॉब्लम का लोन मिलता है ना मैडम
वो आपको मिलेगा बस लेट्स this is not part of the valuation. Okay, so yeah, what are the receipts which are excluded? So when it is from a relative, if it is on occasion of marriage, if it is under a will, if it is in contemplation of death, or it is from an individual by a trust created for the benefit of relatives. So it's a family trust. Then the receipt by the family trust from the individual is exempt. It is not charged and not covered by 56(2)(10). And transactions which are exempt under section 47. And there are specific transactions which are exempt, but now they have expanded. So there are so many different clauses which are covered now, and you can just go through it in this slide. So lot of transactions are now covered. So a lot of ambiguity is done away with. So this is that 50 CA and 56(2)(10). So there can be a double tax. So if a person transfers shares at a price which is lower than the value under 56(2)(10) based on the assets, supposing, then for the transferor there is a trigger of 50 CA, and for the transferee there will again be trigger of 56(2)(10). So there is a huge amount of tax. There is double taxation of the income. Basically, it might be consciously done, because it is to basically curb the mischief. Yeah, although the cost of acquisition will include then the deemed cost, which is considered for 56(2)(10).
मैडम इसमें 10% डिफरेंस माइनस हो जाएगा
क्या चीज का है?
और डिफरेंस इन
नहीं ऐसा नहीं, वो तो exemption means it is a buffer which is given. 10% आपको deduction नहीं मिलता है, नहीं. So this is basically for bringing in an asset into the firm. It can, I think, take a lot of time. So I think I will not cover this. It will, because now there is also amendment to 45. So there's 45(4) also. So now at least under 45(4) it would mostly get taxed. So you can just go through this slide. It is a very different situation. Bonus shares. So whether bonus shares are covered under 56(2)(10), and there are judgments which say no, there is no benefit accruing to the shareholders. So there is no trigger of 56(2)(10) for bonus shares. Sudhir Menon, which is for right issue, that if rights are given in a proportionate manner to all the shareholders, then there is no trigger of 56. That was under 56(2)(7). Now it is 56(2)(10). But only thing is that supposing the allotment, so there are many issues, like people say, okay, we have given right to everybody, and then some people don't exercise the right. So in that case, I will say that yes, there is still an exposure. You cannot say that there won't be an exposure, because you are playing with the provision or the judgments which are there. Though that judgment is also pretty confusing because eventually in that in that case also the rights were not exercised by the same set of shareholders. There were renunciations and all that had happened. So this is that table that now what on valuations can be done by merchant banker and what a CA can do. So most of the valuations are falling under merchant banker and very less by CA. But I feel that if a merchant banker can do a valuation, it would be mostly a chartered accountant only who will be that person. So I don't know why government is discounting our such a good profession, and they think that we are just a tick box kind of a person. That's absolutely, I completely disagree with that. There should be respect for chartered accountants. I have means a lot of self-esteem for myself because I'm a chartered accountant, and I don't know why others don't feel like that. But it is for us to if we feel good about ourselves, we are proud about ourselves, then I think the others also will feel the same way. And I'm sure sooner with our knowledge and expertise, people will again start giving us the respect which we earlier always used to get till the near past. It's all of us, yeah, institute, and all of us have to we yeah, this is something that we should all represent to the government, that why are all these methods given to merchant bankers? You have to, and merchant bank, a CA cannot be a merchant banker if you are a CA in practice, but you can become a registered valuer. So they have purposely kept registered valuers out. They should have got registered valuers because CA can practice as a registered valuer, but they've kept registered valuers out. It is ridiculous. I'm telling you, it is absolutely ridiculous. Registered value, yeah. That is true. Unfortunately, I don't know why there is this kind of an attitude for chartered accountants. I can't comment.
But what CA can do, these two certificates are appearing in merchant bankers.
Everything.
So they can fully do.
They can do everything. Yeah. This is one thing I have brought out here. It's a little complicated thing, which is indirect transfer. So when there is a share of a foreign company which derives substantially its value from an Indian asset, then it will be considered as an asset, capital asset located in India, and the capital gain will be chargeable to tax in India, even though it can be a transfer between two non-resident of some foreign asset, but still it will still be an indirect transfer. I have put up a few slides for the benefit of the the audience here and the members of the study circle. I will just take you through that. I'll take you to the last slide here. So this says that when B into number of shares is, divided by A is more than 50%, then 911 is triggered. Now we will just come to what is B. What is B? B is Indian company. This is value per share of the Indian company. If it is listed, then it is market value on the date plus debt on the spot date divided by number of shares. If it is not listed, it is fair market value on specified date plus debt on specified date upon number of shares. I'll take you to specified date later because specified date is also defined what is specified date. So if it is not listed, then the fair market value on the specified date plus debt. So you are finding out the EV and you are dividing it by number of shares. A little bit of a mismatch. But the reason for the mismatch is also because the way A is defined. What is A? A is really what is the enterprise value of the foreign company. So if the transaction is with unrelated party, in that case, the transfer price plus debt on the specified date is A. It is if it is with related party, that is connected persons, then in case of listed, it is market price on the specified date plus debt on the specified date. And if it is unlisted company, then fair market value on the specified date plus debt on specified date, which means that if you are finding out, value under, or you are trying to find out whether the holding is substantial or not, and the foreign company is not a listed company and the transaction is between related parties, then you will also need to do fair market value. You'll have to determine the fair value of that foreign company and find out the enterprise value by adding the debt of that foreign company, and we find out A, which is the denominator in our equation. Now we come to specified date. So what is specified date? It is the so specified date is the date of transfer or it is the date of the last balance sheet. Now when is it supposed to be the date of transfer? It is date of transfer if the book value on the date of transaction is more than 15, it exceeds the book value of the assets on the last balance sheet by 15%. So if the delta is 15%, then the specified date is the date of transfer. And if the delta is less than 15%, then it is the last balance sheet date. Okay. So if this is more than 50%, then that capital gain becomes chargeable to tax in India. So this whole exercise is just for determining this one little ratio. Okay. So this is just a summary of all the provisions which trigger valuation. So one is issue of shares, which is 56 to 7 we covered. Receipt of shares under 56 to 10 that we covered. Slump sale of business, which I cursorily covered because I don't think it needs to be separately covered. 11 UAE is the rule, so 50B. Then you have income due to accruarize, that is indirect transfer, which is under rule 11 UB. And then perquisite in respect of ESOP. So there again, valuation of shares has to be done for determination of perquisite. Again, for Companies Act purpose, one has to get a registered valuer's report, and registered valuer can be a chartered accountant. Now we come to Fema. So under Fema, this is, when there is, so there has to be a transaction between a resident and non-resident. This is the core of Fema. So if there are issue of shares to a non-resident and the shares are listed, then it should not be at a price lower than the SEBI regulation. So there's an issue of shares. So there is a preferential issue, or so ICDR pricing should prevail. So wherever there is a SEBI regulation, then FEMA mostly aligns with SEBI price. This is how FEMA is. This is the broad understanding. If it is unlisted share, then it should not be at a price lower than the fair value determined as per internationally accepted valuation methodology. This is for issue of shares to non-resident. Now, when there is transfer of shares by resident to non-resident or non-resident to resident, in case of listed shares, again price as per SEBI guidelines, both the cases. Now, when there are unlisted shares, then when the transfer is from resident to non-resident, the fair value is the base value. It should not be lower than the fair value as determined as per internationally accepted valuation methodology. In case of transfer from a non-resident to a resident, it should not be higher than that value. Then you have foreign securities. When a company has invested in a joint venture or wholly owned subsidiary outside India, in which case, if the investment is more than 5 million, then it has to be again merchant banker. If it is less than 5 million, then a CA or a CPA can also do the valuation. And when there is a transfer of shares by resident, then in case of listed shares, price on the stock exchange, and in case of unlisted shares, price not lower than the price determined by a CA or CPA. There is some exemption which is provided in case of unlisted, where you don't have to, if it is less than 10 million, then you don't have to go for approval route if you are selling at a loss also. So if you are writing down investment, or if you are selling your investment in the overseas subsidiary at a loss, then you actually have to go to the Reserve Bank for an approval. But in case if it is less, there are certain criteria which are laid down by a notification of RBI, and if it is falling within that, then you don't have to go to RBI for approval. But the interpretation I recently came across in such a case was that fair value requirement is done away with. No, that is not, no, that is not correct. You have to get a fair valuation done, but you don't have to go to Reserve Bank, although you are writing down the investment if you are satisfying those conditions. Fair value. Fair value. Okay. Yeah, threshold. So one thing is the investment should not be more than 10 million. Investment amount means the invested amount in your wholly owned subsidiary should be lower than 10 million.
There is asking for valuation. You do overseas investment.
Yes.
You know, fully owned subsidiary.
Yeah, so if you, I'm talking about a transfer of shares of a wholly owned subsidiary. So if there's a transfer of shares, then the reserve, means the AD will obviously ask for all the base documents, which will include the fair valuation report also. Now, if you are transferring at a profit, no problem. But if you are transferring at a loss, then only you need to be careful that you have to be below that threshold of 10 million. If you are not below that 10 million threshold, then you have to go for approval. Okay, so I had touched upon this acquisition of shares through right issue under Fema. If the shares are offered to at the same price to a resident, then issue of shares means right shares to non-resident does not require an arm's length price determination. That is, fair valuation need not be done. But if you are not offering to residents, so if there are no residents, in case of a right issue, supposing it's a wholly owned subsidiary of a foreign company, then you will have to get a fair valuation done. So there is no umbrella exemption for right issue. Only this condition has to be satisfied, then it is exempt. Issue of shares by an Indian company to person resident outside India, all these I covered, all these. Swap of capital instrument, that has to be valued by merchant banker or investment banker. Fresh issue is again fresh issue at the time of subscription does not require a fair valuation to be done. So when there is subscription to memorandum and article, there's a separate, there's an exemption which is provided. It need not be done based on fair value, because at that point it's very difficult, you can't arrive at a, fair value. Issue of warrants and convertible instruments. Here, in case of convertible instruments, you have to upfront give the conversion ratio also, or at least the mechanism of conversion should be given upfront. And the price for conversion should be given upfront. Then maybe you can set that as a floor price. You can set that as a floor price, because often you cannot judge what will be the fair value at the time of conversion, because often conversion is based on fair value, but you will still have to give upfront that okay, conversion will be, this is the mechanism and this is the fair value upfront of those instruments into which it will get converted. Outbound investment, that also I talked about. That's it. So I hope that was I covered in time.
Thank you, ma'am, for this detailed deliberation on valuations under income tax and Fema provisions. I would like to invite C. Nidhi Corporate Member, for professing the formal. Thanks. Just one announcement. We have a meeting planned on 11th of November. It is a combined meeting with WIRC, and accounting standards will be covered therein. I'll be sharing the details in 2 to 3 days. So I request you all to attend and take benefit of it. Thank you, Purvi, for the pleasant task. It is said that Warren Buffett, managers and investors alike must understand that accounting numbers are the beginning, not the end of business valuation. So thank you, Drushti, Drushti Desai, for enlightening us on so many things about valuation, including Fema,
It was really enlightening and it was very interactive session, which was the best. You answered all the questions of the participants. I request you all to please carry a round of applause for us.
Have a lucky draw also.
ये वाला जरूरी है देखिए आपका नाम
Lucky draw is very at least you are there. Answers started up more because are there, written there, certain. Those are not available on 1.1 people, they are